Good morning, everybody. This is Martin Mesa with Rate 1 Financial Incorporated, mortgage banker broker in Pasadena. It is Cinco de Mayo today. That's May 5th for all those who didn't understand. I'm in Southern California, and it's a big day today, celebration-wise, because a lot of people celebrate Cinco de Mayo today. So enjoy your Cinco de Mayo today. Go out to a Mexican restaurant, maybe, and get yourself a margarita or something. I don't know. Anyway, today I'm happy to present a little bit about what lenders look at for income, and I'm just going to be very general about it. So typically the way lenders look at any type of income source, by the way, you can use any type of income source to qualify for a loan. Lenders cannot discriminate against the type of income source, no matter what it is. Believe me, no matter what it is, because if so, that's a violation of the Equal Credit Opportunity Act and Fair Lending Law Act. But in general, lenders want to see two things regarding income. They typically want to see a 2-year track record of receiving that income, unless it's something you just fell into. Like, for example, if you just graduated from college and you got a new job, then you don't need a 2-year history, obviously, because it makes sense that you weren't working before then. But in general, any kind of income stream, they want a 2-year history, and they also want to have a very high likelihood to reasonably assume that that income stream is going to continue out for the next 3 years after your loan closes. That's the litmus test for determining whether or not any type of income source can be used for qualifying for a loan. I'll just give you the brief example. Most people are W-2 employees, which means they get pay stubs, they get W-2s at the end of the year. If you're a full-time employee or a salaried employee, they can pretty much guarantee that you're going to get your salary for the next 3 years. Or if you're a full-time employee, that you're going to get at least paid 40 hours a week. So they'll give you credit for that no matter what. You don't really have to have a 2-year history for that, but you definitely want to have a 3-year continuance likelihood of it. Otherwise, they won't use it. The other types of income you see on a W-2 or a pay stub would be like things that fluctuate, like bonus, overtime, commission, or any kind of incentive pay, or if you're a part-time employee with fluctuating hours that go up and down every month. Any of those types of things, they're definitely going to need to see a 2-year history of receiving it, because they need a 2-year track record in order to determine an accurate monthly average. What they'll do is they'll take that, they'll divide it by 24 months, and they'll give you credit for that on a monthly basis as income, but only if you have at least a 2-year history of receiving it. So in general, any type of income that fluctuates or isn't guaranteed to be steady from month to month, they're going to want to see a 2-year average, a 2-year history, and take a 2-year average for monthly, and that's what they'll give you credit for. And that's it. That's kind of real brief, but in a nutshell, that's how they look at any type of income source. And you cannot discriminate against the type of income source as long as it meets that criteria. And you can document it. You have to be able to document the income. It can't be cash income that you're receiving that nobody knows where it came from. It has to be documented either through pay stubs, W-2s, tax returns, or the like. So anyway, that's that, and that's pretty much how lenders look at any type of income as to whether or not they could use it for qualifying. So hopefully you found that helpful today. A little bit more of an education on what lenders do every day regarding qualifying income. If you like this video, feel free to look at the past videos we've put out. Somewhere on this screen you'll see a place to click on to look at those, and feel free to like and share. Have a great day.